everyone. Thanks for joining us for another episode of Coffee with Carl. Today, Carl will be talking with Matt Reardon. He is an assistant vice president, portfolio specialist at ClearBridge. Matt provides capital markets and economic analysis, as well as portfolio construction and fundamental equity research insights to audiences ranging from broker-dealers, financial advisors, institutional clients, and investment consultants. And he received a BA in economics from the University of Michigan. So welcome, Matt. Thanks for joining us.
Thanks so much, and thank you for having me on. So today I'm going to be going through our ClearBridge Anatomy of a Recession program. This is one of our, really flagship programs, I would say, that we've been running for several years now. Really the genesis of why we brought this program and have, invested so much time and effort into it is we really wanted to give our clients, give financial advisors simple and easy tools to follow, really to track what we think is going to happen with the economy, what we think the best opportunities are in the market, and then ultimately how we're managing our portfolios. Because at ClearBridge, we're a long only equity manager. All we do is think about, stocks from a business owner's perspective. We tend to have a very long-term time horizon, which I think tends to get lost in a lot of the news and a lot of the headline noise that people are stuck with on a day-to-day basis. So I think as we go through this presentation, you'll see that it's not as complicated as people might expect, but ultimately, hopefully you walk away with some constructive tools to really help identify what you think is really going to matter going forward. So I'll start with the investor pitfalls section, and this is kind of what we try to avoid as investors, right? Is falling victim to these panic attacks, and we've had an infinite amount of them going back through history. But if you even just look back over the last 20 plus years, we've had so many different events that have caused very short-term impacts to the market, but over the long term always tend to get recuperated. So whether that's the regional banking crisis we had in 2023, whether that's COVID, which obviously, you look at the correction we had during COVID and how much the market has continued to rip higher since then. A lot of these opportunities or these panic attacks present opportunities when things like this arise in the market. But ultimately what happens to the average investor is they get scared out of the market. And so what we did was look at the average annual returns for the average investor, compared it across asset classes. And really you see the average investor is just barely outpacing inflation at 3.1% average annual returns, inflation at 2.5. And then you look at a typical US stock up 9.8%, going back through that time frame. So that's really what we try to avoid. The other key piece is that volatility is not a financial loss until you sell. Market swings are very common. If you look at just so far this year, we had a massive up year in the first quarter. Now the market has started to consolidate and tread lower. This is all very common. It's also very common in an election year, which is, obviously what we're in right now. Typically, these swings can be more violent as a result of an election year. But ultimately, your average gains are going to outpace your average correction. And so this is really, I think, one of the more powerful charts within this presentation when you just take the market as a whole into perspective. More often than not, the market's your friend. Over the last, almost 100 years, going back to 1926, the market's been positive 73% of the time. If you look at the just sheer amount of times that the market has been up 20%, 37 times versus the market being down 20%. Just 6 times. So again, more often than not, the market is your friend. We never try to, time the market. So I want to also bring this back together. What we looked at here is what an investor's overall return would be if they had just bought and held consistently since 1945, versus someone who had tried to time the market by either, buying back in after the market trough or buying or selling out before the market peaked. And your cumulative return is about 4 times as much had you just bought and hold versus trying to time the market. So just wanted to put that in perspective before we kind of shift over to the economic side. So I think for the economy itself, obviously everybody's been talking about recession. This presentation itself is called The Anatomy of a Recession, but we haven't had one yet. And so I think it's caused a lot of, confusion for the average person. There's a lot of different dynamics to kind of drill down here, but really our guiding sort of set of principles comes to this dashboard right here. This is our recession risk dashboard. And it's really a set of 12 variables that we've gone through hundreds of thousands of data points to determine that really give us an accurate prediction of whether or not a recession is likely. And so we break it down into three different segments of the economy. You have the consumer, which takes up the bulk of the dashboard's overall weighting, because the consumer is really the driver of the US economy. It's about 70% of US GDP is consumption. And then we also look at business activity. We look at things like commodity prices, ISM manufacturing data like new orders, profit margins and truck shipments, which give us a little bit more of a kind of nuanced take, because not everybody is following things like truck shipments as a traditional economic measure. And then we also look at financial conditions. So we look at the yield curve, we look at the money supply, which is obviously caught a lot of attention, right? When you think of all the stimulus that was produced during COVID, and is still kind of working its way through the system and still continuing to normalize. But overall, if you look at that bottom line that's highlighted, this creates our overall dashboard signal. And so really it's a simple stoplight analogy where a green overall signal means expansion, yellow means caution, and then a red overall signal would signal to us that a recession is likely. And so what you see that trend really over the past, almost a year now, is that we were flashing red in September, and we've slowly improved to an overall yellow signal. And so really our base case for the economy at this point is that a soft landing is the most likely outcome. We essentially are putting about a 65% chance of a soft landing going forward from here, which is really to say that the economy is tightening financial conditions as a result of the rise in interest rates that we've seen, but we don't expect a recession to occur as a result. So this is really the ideal outcome, and this is what the dashboard is starting to reflect. But just a few things I would touch on. One of the improvements that we've seen is within the housing sector. So housing permits at the top of the dashboard there went from red to yellow. You don't have to have or look very far to understand how much pain and volatility has gone on in the housing sector, with everybody moving in hordes during COVID to seal in new houses, and now no one wants to leave because your asset has appreciated so much. You don't want to give up your low rate that you locked in and move in somewhere with a 7% mortgage at this point. But that is starting to improve. We've seen housing starts. New home sales actually start to inflect positively the other way, which is normally a very good sign for the economy. The other thing I would highlight is jobless claims, which I'll also touch on a little bit further down the line, but this is one of the best indicators that we have. It's essentially just people filing for unemployment and tracking that trend over time. And that indicator has never turned red at any point over the last 5 years. And so we think that's really the key component to this soft landing that we're expecting. It really comes down to two things. It comes down to the labor market, and it comes down to consumption. And so you could put housing into that consumption segment. Obviously, jobless claims are going to tie into the labor market. But that's really what's driven the soft landing and this kind of more positive tone that we're expecting for the economy going forward. So this is the first sort of step we'll take, is just kind of looking at the labor market and why people expected this recession to occur as a result of the rise in interest rates that we've seen. And so typically in a recession, if you look at the left side of this chart, what we're looking at is the average monthly job creation for the economy. And so typically in a recession, you get this kind of steadily downward trend, and then it very quickly flips right as that recession begins into the negative territory. And so far, what we've actually seen is the chart on the right, where we had a sort of mild slowdown in the employment picture, but it's actually reaccelerated over the course of the year. I will say it's also continued to moderate. We just had another jobs report on Friday, which was a bit lower than most people expected. But again, this is all something that we think is very constructive and part of this normalization of labor that we expect to continue. And part of it really has to do with just supply and demand of labor. And so if you think about the massive distortions that we had during COVID, where most people in service industries, whether it's hospitality, restaurants, hotels, many of them were very significantly displaced and took a long time to ultimately come back into the labor market. And so if you look at the amount of job openings that we had peaking at essentially 12 million at the end of 2021. That slowly started to normalize, but we're also still above where we were before the pandemic. So we've had this massive bump um, in job openings or demand for labor, and the supply really hasn't fully caught up yet. So this has allowed basically unemployment to be very steady over the past call it 2 years now. We've barely been close to 4% unemployment, which for all intents and purposes is by no means a recessionary indicator. It's a almost an extremely healthy signal of the labor market right now. But we think this trend will continue and is ultimately a healthy part of the labor market coming back into normal as we were before the pandemic. And then also the consumer, right? So I mentioned this was the other key piece to the soft landing coming into fruition is consumption hanging in there. And part of that reason the consumer has been able to hold in is that ultimately they are less interest rate sensitive than they were, in previous tightening cycles where the Fed has raised interest rates, or even in previous recessions. So if you look back to, the last several years, we've been on this downward trend. If what we're looking at here on this chart is the average mortgage rate for the consumer. Currently, what the average consumer is exposed to in terms of their mortgage is 3.8%. And what's the current 30-year fixed rate at? 7.25%. So what that means is the average consumer is not actually experiencing the pain of higher interest rates as it relates to the housing sector, right? It's caused obviously some distortion between supply and demand because a lot of people want to stay in their homes and don't want to move on. But the average consumer, while mortgage payments have gone up significantly over the past, call it year and a half, the average consumer is not, really paying into that. It's been much more of the sort of higher end consumer that's been more willing to pay that higher rate for their mortgage and sort of take the higher cost of mortgage payments. But ultimately, the U.S. consumer has been much less interest rate sensitive than they have been in the past. And then not only that, if you trend that out to the corporate level as well, businesses did the exact same thing. They locked in the lower rates during COVID. Interest rate payments, which typically tend to rise alongside increases in interest rates from the Fed. They usually pressure margins, but in this case, so many companies, again, were very vigilant in locking in those low rates in that sort of post-COVID environment, and even over the past decade, post the Great Financial Crisis. Net interest expense, so the money that they're actually paying as a result of higher interest rates, is actually much lower than it would be in other cycles. And so that's what we're really tracking here is corporate interest payments as a percentage of overall GDP. And even while the Fed has rapidly raised rates, if you look at that trend from 2020 onward, as a percentage of overall GDP, companies are spending less as a result of that. So this has ultimately allowed companies to hang in much better. It's allowed margins and productivity to hold in much better that people ultimately expected. And so just in terms of the economy, right? So it really comes down to, the soft landing comes down to consumption hanging in better and the labor market. And those were kind of the key things that we had flagged over the last 2 years when we started to see, some economic weakness working its way into the dashboard. But given the fact that unemployment has been very robust and that we've still been able to continue to add jobs at a healthy clip each month, we don't see any immediate sort of negative flip for the labor market. We think that even layoffs themselves should be less likely because if you think from a company perspective, it's been so hard to bring employees back in to the labor force, and that dynamic is still going on and has allowed the labor market to hold in much better. And then consumer as well. Again, we flagged that the housing market is starting to improve. Consumers are less interest rate sensitive than they have been in the past, and have ultimately been able to spend at a pretty healthy clip as well without having to retrench and be a bit more mindful of their expenses. So shifting over to the market side, obviously, the market is very different from the economy, and and vice versa. And this has been a very interesting market going back to 2023. The dominant story has obviously been the Magnificent Seven. So that's Apple, Amazon, Google, Microsoft, Meta, Nvidia, and Tesla. I'm sure everybody's heard of these companies and is probably tired of them at this point. But this has really been one of the most prolific runs we've ever seen and one of the more concentrated runs that we've ever seen. But so I think what 2023 was, it was obviously the year of the Magnificent Seven. But if you look at that red line from the October 27th in market low, what we actually saw was an improvement in different segments of the market. So not just the Magnificent Seven doing well, but also mid cap stocks, the rest of essentially the S&P 493, excluding those seven stocks. Small caps did well, value also did well. So we saw a broadening out of the market, and this is one of the key dynamics that we think should continue to play out throughout the year, in particular with the likelihood of interest rates coming down over the next couple of years. We think this broadening out is ultimately very constructive for the market and also presents some very good opportunities for us as investors. But one of the things I would also flag is just this dynamic of concentration that we've seen, and this is essentially never been reached before, this level of concentration. And this is just looking at the S&P 500 and the top 5 weights that they have as a sort of bulk of its composition. And right now we're at 25.3%. That's basically double what it was in 1990, and that's led to a very concentrated return profile for the overall market. But what I would flag is that if we looked at 2023 as a whole, those top 5 stocks accounted for basically 50% of the entire market's return. And then you fast forward to the first quarter of 2024, and that dropped off to 34%. So that also ties into this broadening out of the market, right? Which is very healthy. You don't want, only 7 stocks being able to drive portfolios. This isn't another way to look at it, where you have, the top 5 are having less and less of an impact as we kind of move through the year. And so, the other sort of dynamic that this ties into is valuation, right? So the market has obviously had this massive run over the last couple of years. Is now a bad time, and is the market too expensive? We would argue that it's really not as expensive as it might seem on paper. So right now the market is trading at about 21 times next month earnings. So a little bit above what you would normally see historically, which is around 17 or 18 times. But sometimes these historical comparisons can really, not be as applicable, today as they were, back in the 1950s or 1960s, or what have you. And we think that the higher valuation that the market is garnering right now is really a result of its composition itself. And so if we looked at the different sectors that make up the market, the more growthy sectors like like technology, communication services, consumer discretionary, they've continued to grow as a overall component of the market. About 71% is in those much more growthy sectors that typically tend to be a bit more expensive. They tend to garner a higher valuation for that growth. And then if you look at the other side, the more cyclical segment of the market, companies or sectors that are more exposed to fluctuations in the economy and things of that nature. So like financials companies, like banks, industrial companies, materials, energy stocks, those have actually gone down to pretty de minimis amount of the overall market's composition. So again, this is a much different market than we saw in the 1950s and 1960s. We have a much more growth oriented market, and even within that sort of growth segment, companies now have much less financial leverage. They're not drowning in debt. They have much greater profitability than decades past, and all of that supports this idea of a higher valuation, where the market really might seem expensive on paper relative to history, but given the higher quality that these companies have and given the overall composition, we don't think it's as expensive as you might expect. And so taking a deeper look into this kind of broadening out that I had mentioned, we've seen this divergence between the Magnificent Seven, where you have NVIDIA really driving the bulk of the returns so far this year amongst this group, and the rest have kind of trailed significantly or have really fallen off, like a Tesla. And so I think NVIDIA is really driving the boat here, because everybody in this group is buying NVIDIA's products, and that continues to be the case. And ClearBridge as a firm continues to be constructive on what that long-term growth ultimately looks like for a company like NVIDIA. But there's been this big divergence, right? So You think of Tesla with all the weakness that they've seen on the EV side. They've been cutting prices, across several different geographies, across several different markets. They're facing competition from companies in China and different companies internationally. And then you look at the other sort of outperformers like a Meta, which was, you know, really cast away as, nobody wanted to touch it in 2022. Amazon kind of a similar thing, and now they're actually starting to see an improvement in the business. So there's been this divergence, which I think again really just ties to a broadening out of market participation. And so this is also being driven if you look at how much these companies are expected to grow earnings over the next several years. And so 2023, we think it actually makes sense that the Magnificent Seven was able to do so well because that's where the earnings growth was. The average EPS growth or earnings per share growth for those companies was 34% in 2023. If you looked at the rest of the S&P 500, it was negative 4%. And then if you look at the small cap segment of the market, it was minus 10.5%. And so that was 2023, what actually happened. And then now we're looking at the projections going forward. So 2024, you see the Magnificent Seven earnings expectations actually drop down to 24%. And then you see this big lift up for the other parts of the market. So the S&P 493, small caps start to see that initial acceleration in earnings growth, which we think again will attract more capital, result in this broadening out. And then looking at even further into 2025, this dynamic continues where the Magnificent Seven faces some tougher, comparisons from the year before. Earnings growth drops down to, around 17%, while again, the rest of the market, S&P 493 and small caps really continue that acceleration where you're looking at very significant earnings growth for right now. Those, the rest of the market is trading at a much more attractive valuation. There's a lot, more sort of downbeat sentiment in different pockets of the market that we think are really going to, garner much more attention as we kind of move forward over the next 2 years. But really the big catalyst.
Matt,
Yep.
real quick. I want to go back to the last slide. So if you guys are projecting growth in the, pretty significant growth in the small cap space, how are you guys looking at that just for a market, overall market analysis? Are you seeing that as being potentially the best sector for you guys to go into? Because right now, I mean, one would argue if I'm looking at it from a 401k participant or just a general investor, why would I invest anywhere else? You can just buy large tech or the S&P 500, and you really haven't been compensated for going outside of that sector. So maybe a little bit of color on, on this chart as to what this means for market returns and potentially opportunity and valuation.
For sure. So, I think it's a couple fold. And so this is, by the way, this is not a a sort of ClearBridge expectation. This is actually just based off of consensus expectations across the street. But I think it really comes down to, part of it is the Magnificent Seven had just massive growth over the past couple of years, and you're going to face those tough comparisons from the years before, and there will be a natural sort of consolidation within that. I think if you look at the rest of the universe, in particular small caps in general, small caps tend to be much more interest rate sensitive, much more economically sensitive. And I think part of the reason that you see the shift in expectations going forward is a result of interest rate cuts, and what that ultimately means for a resurgence of economic activity. Because once the Fed cuts, the economy actually accelerates very quickly. It doesn't take a lot of time to really start taking off. And so that's partially, I think, what's being factored in here. But you also just look at the amount of capital that's been soaked up by the Magnificent Seven. You're talking about multiple, trillion-dollar companies that continue to, be your post earnings be up 20% on any given day. They've just soaked up so much capital. But you look at the more kind of unloved sectors of the market, like within small caps, whether that's in areas like financials where multiples have been incredibly depressed, the consumer, which has been in a very choppy, kind of uncertain environment, but is actually starting to improve. We continue to find ideas in those sectors, particularly on even in value, which has been at pretty historic disparities relative to growth. And I think even as we go further, I'll definitely hit on a few more slides that kind of highlight those opportunities.
Okay, perfect.
Great. So as I had mentioned, interest rate cuts are kind of one of the key catalysts that we expect to ultimately spur this trend forward. And so what happens when that first interest rate comes? The 10-year drops, and so the 10-year does have a sort of effect on the equity market, right? It's kind of the judge of where you can get returns, right? Can you get returns in fixed income, or are you getting compensated for that in the equity market? And so looking forward, we broke down what asset classes tend to do best following that cut in interest rates. So typically in an average cycle, you see that cash actually tends to perform decently well at 7.7% if you just put it in 3-month T-bills. But if you go towards a soft landing, that blue highlighted line at the bottom of this chart, you can see that equities actually tend to outperform very significantly. And this is, again, our base case for the economy is that soft landing scenario. And once you have that initial interest rate cut and look out 12 months, that forward price return, you're looking at large cap growth, that Russell 1000 growth up 16% in that 12-month period following. Value even does well at 14.5%. And then mid caps and small caps also keep up. So you get this, really broad rally. Large cap growth tends to be the best, but ultimately in a soft landing scenario, equities are going to be the place to be. And a lot of people have, been putting money into money markets and trying to take advantage of this interest rate environment that we're in. But ultimately, equities are a very good place to be when it comes to a soft landing. And then the other thing too, again, the market has had this sort of massive rip up. And a lot of people are concerned around all-time highs and what that means for forward returns. Really, what we looked at here was what your average return would be looking forward. How do you put money in at the all-time high versus all other periods against that? And you actually had better results by putting in money at the all-time high and sort of playing that dynamic of strength begetting strength and looking out forward for for the market. You actually surprisingly to even to us when we ran this analysis, you were actually better off by putting money in at the all-time highs because of the way the market tends to beget that strength once it has that initial momentum. So and lastly, before I kind of shift over to different opportunities from a sort of sector perspective and an asset class perspective, this is really our broader view when we take kind of wide lens to the market and to the economy. It's our view that we're in this long-term secular bull market, which tend to typically last about 20 years. So 1980 to 2000, you had about 1,260% cumulative return with 500 all-time highs. You compare that to 2010 and what we've seen so far through now, we're still significantly lower in terms of all-time highs at only 368. And then that cumulative return is about 1/4 of what we saw in those 2 decades from 1980 to 2000. So we think we're ultimately part of this long-term secular bull market. This has kind of been a digestion period from 2022, and even parts of 2024, you could say. But I think over the long term, this is our view, and this is tends to be what plays out from a historical perspective. So just to recap again before I shift into different market leadership slides, for the economy, we are expecting that soft landing as a result of consumption hanging in better than expected and stable employment and stable job growth going forward, with improvements in different sectors like manufacturing and like housing, which should continue to provide that strength. And then for the market, again, the market is not as expensive as it might seem, despite a relatively higher valuation relative to history. We think that multiple is justified given the strength of these companies and the way that these indexes are currently constructed. And then that broadening out of leadership. We think that as earnings growth starts to accelerate for those other unloved sort of sectors of the market on the small cap side and in the S&P 493. We think this is actually a good entry point for investors that are trying to be a bit more opportunistic and take advantage of that. So shifting over to the market leadership side, I had mentioned this dynamic of people flocking into money market funds and short-term instruments. We've seen a massive amount of growth in money market funds over the last 2 years. 18 months. It's totaling about $6 trillion that's sitting in money market funds. But the thing is, while you're sitting in, or you might be happy in, 5% preferred cash, eventually that's going to end, and it's going to come down, and you're not going to be able to get that return that you could get. And so that money has to go somewhere. And so we think that this is, again, coupled with those cuts, interest rate cuts that are expected over the next 2 years, this could be a good source of capital that starts to flow into the equity markets. So one of the bigger, places to be if you're of the belief that, large cap growth can continue to do well, and you still think that the Magnificent Seven is going to dominate over the next couple of years. Typically, when you have a decline of 25% or more in the large cap growth index, you've been very well rewarded over the next several years. So we looked out every time that 25% decline occurred, and it happened in 2022. Excuse me. 2022 with a 33% decline. Looking at 1 year, we were actually below average returns relative to history. But if you look 3, 5, and 10 years out, your average returns are 80%, 171%, and 372% over that 10-year period. So when you get these big declines in growth, it tends to be a very good entry point over the long term. I think one of the best places to be in terms of just the stability and being mindful of the uncertainty that's out there for the market and the economy is dividend growth. So companies that not only pay a dividend, but also continue or have a track record of growing that dividend over time. And you're getting a few different things with this. You're getting, number one, a stable source of income, but number two, a source of income that's growing and outpacing inflation. And so you have, inflation at, call it 3% right now. It could, pop back up to 3.5, 3. Who knows how long we could be in this kind of intermediate period. Dividend growth offers you a buffer to that inflation. So we've historically at ClearBridge, we have our dividend strategy, which typically compounds dividends at about 10% per year. So again, you're getting that very stable source of income, you're growing it and compounding it over time. But these are also very mature businesses that are later in their life cycle. They have the cash to return to shareholders. They tend to be market leaders and much more stable businesses. And in terms of the entry point, what we looked at here in this chart is the underperformance relative to the broader market. So typically when you reach this level at about 12.3%, where dividend growth stocks have underperformed at this level, you get a big reacceleration. And we saw it in the 1990s. We saw it in 2020 through 2021, where dividend growth really, had a strong role in the market. And we think that's likely to be the case going forward. And I think, again, these kind of companies tend to be very stable, such that, even if we do get a market correction, you're likely not going to catch as much downside. But should we continue to chug along, and the overall economy holds in better than expected, dividend growth is those companies are going to be able to capture a good amount of that market melt up. So I think this is, again, one of the best places to be in terms of just shooting down the middle and being able to watch yourself both ways. And then also looking at just value relative to growth. So I think this is a really powerful slide if you think about it in terms of your overall exposure as an investor. And so what that line at the top is the essentially the diversification benefit you get from value. And when it's above that line at the 0 level, that's when you get the least diversification benefit. And when the further below that line that it is, you get a greater diversification benefit. So we're looking at really the correlation between value and growth. And it's basically never been at this low of a level. So you have growth and value working essentially in opposite directions at this point in time. And we think it's actually a pretty good time to be looking at value because, again, you have that acceleration in earnings growth that's expected from the S&P 493 outside of Magnificent Seven, and particularly on small caps as well. And being able to diversify with value has been proven to really just generate stronger overall returns over the long term, and being diversified as well. Again, with the index or indices increasingly concentrated in a handful of stocks that are driving returns, should that unwind, it's good to have that value exposure when the market starts to flip, because the market often is going to cling to last cycle's winners. They don't want to have this, regime change. Everybody's afraid of, these big shifts that happen, but they always end up happening. And so having that diversification benefit by looking at value, I think is, again, a very prudent thing to do at this point. And then lastly, before I kind of open it up to any questions, is just around the small and mid cap side as well. So small and mid caps really tend to be the initial wave of outperformance when you get a sort of broader market rally. And we saw it in the fourth quarter of 2023, where the market really started to jump on the hopes of interest rate cuts. And you saw small caps and mid caps meaningfully outperform large caps. And that's because typically when you get a sort of economic reacceleration, it always starts with those that are most sensitive to it. So starts in the smaller cap segment of the market, tends to work its way up to the mid cap side. You get that broader rally that's part of that reacceleration.
Mhm.
And right now, from a valuation perspective, small and mid cap stocks are incredibly cheap relative to large caps. So you have the setup there in terms of an attractive entry point. You have the potential catalysts going forward with interest rates and with earnings potential. And again, if you want to be a bit more opportunistic, we think the small and mid cap side is an increasingly attractive place to be. But with that, I'll stop my comments and open up to any questions.
Yeah, guys, if you guys want to send any questions to the chat, please feel free. All right, so a couple on my end. Yeah, obviously you hit on the opportunity potentially in the small and mid cap segment. Right now it seems the Fed's projecting to call 2 to 3 rate cuts. How are you guys looking at the market? Let's just say they do none, because right now inflation's consumer's very strong. Inflation's already kind of reaccelerated, it seems. So if you guys were to take another look at it from a just no rate cut, how would you guys be pricing the market?
Yeah, and so I think one of the things that we were much more cautious on relative to a lot of firms was, we were very aware of the optimism that was priced into the market at 2023, which was soft landing, 5 or 6 interest rate cuts for the year, and really just kind of this Goldilocks scenario that looked like a very optimistic situation. And so what we've done across portfolios and throughout 2023, more towards the back half, was really take down those areas of the portfolio where multiples had gotten extended. So within technology, within certain communication services, or even consumer names where valuation was extended, we knew those areas were going to be most at risk, where you get a hawkish repricing of expectations, where you go from now, maybe 1, 2, maybe 0 interest rate cuts for the year. That's a much different environment than what people were expecting at the end of 2023. So for us, it's always been, bottom up fundamental research. So we're not making bets or portfolios dependent on interest rates going, one way or the other. But what these big swings tend to do is just present opportunities for us, if nothing else. So you get, big swings in sentiment, big swings in leadership, and these very quick rotations. So I think the actions we took in 23 and being mindful of what was priced into the market, but then being able to use this volatility to our advantage at the individual stock level, is kind of, how you make money in this kind of environment.
Yeah, I mean, and maybe I guess more directly, what is that, from a return subset? I mean, if you don't get those rate increases and the market's baking in, we're calling up almost 9.5%. Are we projecting more like negative returns in a year, or a big sell off, or is that just, hey, we didn't get it, but as long as we get the earnings growth, because I was listening to one economist and they're looking at the market as pretty overvalued. So how do you guys think about, more so the asset prices? Obviously, I think more, up high level.
Yeah. Yeah. So I think, the market can still be strong with rates where they are. I mean, 2023 is probably, prime case in point. I think it's going to continue to weigh on, again, the small and mid cap side. That's probably likely to continue to be challenged. But I think if anything else, it likely favors value at this point. You might see value outperform if we are kind of firmly in this higher for longer standpoint. But I don't think a big correction is kind of what we're expecting. I don't think we're expecting any sort of heroic return for the year, but the market can still be strong with rates where they are at this point.
Any thoughts on, international markets as far as just an asset class? Because obviously
Mhm.
valuations are more attractive. They just have fundamentally underperformed. Now you're starting to see some outperformance called like Japan in some segments, but any
Mhm.
thoughts on, that in relation to kind of US markets and, opportunity set?
Yeah, so I actually do have a couple slides I can point to here. So it's been a very long period of U.S. outperformance, really from 2008 onward. But you do get these periods over time where international snaps back and snaps back pretty quickly. Um, so looking at it here, again, you pointed out from a valuation perspective, international has always been relatively cheap compared to the US. And that is, continues to be the case now, but even more dramatically so. Um, I think in terms of the central bank environment internationally, you might actually get a quicker easing of financial conditions overseas than you would in the U.S. with the ECB. Obviously, there's some economic risk when you look at the UK, which is still kind of going through some turbulence. Germany, kind of a similar dynamic there. But Japan, like you had mentioned, is really been a huge driver of outperformance. It's been, really, if you look past over the last, 30, 40 years, Japan has not been a very good market to be invested in. But it's really, been one of the best performing markets, across the world geographically. So there's definitely opportunities there. I think one of the last thing I'll just say is just around the dollar. So typically when you move into this declining interest rate environment, you get the weakening dollar as a result, and this really tends to kind of supercharge performance of international stocks, particularly on the emerging market side. So a few things to keep in mind, but yeah, valuations are attractive. Japan is, in a much better place, and then a weaker dollar tends to boost international as well.
Yeah, that's helpful. Yeah, because one of the things I've seen is just a really underallocated portfolios across the board when it comes to international, and I certainly see why. So I think it's always helpful to put that in context as potential opportunity set for investors. As far as maybe just on the sector side, it seems like tech is probably is tech still probably one of your best places that you guys are looking to for opportunity, just from a total return standpoint, or any other maybe sectors you really like. I mean, because when we look at returns like healthcare and consumers, healthcare has been non-existent from a return set.
Yeah.
Like consumer side, where do you any other sectors you see as great opportunity?
Yeah. So tech is definitely an area I'd say across the board we've gotten much more constructive on the semiconductor environment. It's been a bit skewed because of the impact that AI has had, and so those who have exposure to things like data center, or if you're NVIDIA making GPUs, you've done well regardless. But the other key pieces of that are the auto segment, which has been kind of in the doldrums recently, but is starting to reverse. Even in the industrial segment as well, we're starting to get a bit more constructive, but a lot of different interesting semiconductor plays that are actually starting to see improvements in demand for the end markets. So we really like the setup there over the next couple of years. Other areas I think we're, increasingly more instructive on are those that have kind of already had their recession, or they're kind of normalizing the post-COVID excesses that took a bit longer than people initially expected. So even in, healthcare, which has not been a very strong performing sector over the last couple of years, they faced a number of, unique kind of headwinds there within, tools, devices, again, where trends have actually started to bottom out and move the other way. Even in the housing sector as well, we've gotten a bit more constructive. You know, I alluded to it earlier on the dashboard, but you're starting to see an improving trend there. So I think we're really looking at areas where, the fundamentals are starting to inflect positively the other way. That's where the opportunities are. I think even within tech, we're not saying that the Magnificent Seven can't continue to do well. they likely will. But the magnitude of outperformance that they've had is likely not going to be as much as what we saw over the last year and a half.
Yeah, and you just highlighted AI. I mean, I get that question fairly often. Where is the opportunity? What should I invest in? You know, and I think it's very tough for investors, right? Because they hear about all the money being made, by some of the investors, whether it may be venture, et cetera. But maybe some color as to, if you're a retail investor, how to be thinking about AI and how you can invest in it, or is it maybe a little bit too late to, just start trying to chase some of these big companies like Nvidia? And maybe you should be going after like a Walmart for the opportunity that AI can do for them. So maybe a little bit of color there. How should you guys think about it?
Yeah, so I mean, this is really the top of the first inning in our view when it comes to AI. This is a very much a build out infrastructure phase, and so the initial winners are who the market's flocking to, because if you're winning right now, you just happen to be in the right place at the right time, and that's Nvidia number one. And no discredit to them, they have a massive technology advantage compared to anyone else, and in many ways they garner the valuation that they've earned at this point. But today's winners are likely going to cede share at some point to more companies further down the line, because we think the bigger picture here, AI is going to be a massive market, and there's going to be room for a lot of different players, and there's going to be room for continuous innovation. And so right now we're still in this kind of infrastructure phase. Right now the next step is more around application, and so you look at companies that are storing massive amounts of data. Those are the ones that have really the biggest advantage, whether that's customer data, different sort of behavioral data like that, and being able to use AI to customize that information and make it truly unique to the user. That's really the next step, and that's where you could get new companies stepping in, either from the private side that start going public over the next call it year and a half, where IPOs have been virtually non-existent since 2022. So we think there's a lot of new opportunity there. It's probably going to impact different sectors in ways that we haven't even thought of today. But I think even now you can definitely look across the board in semiconductors, and even some of the semiconductor equipment manufacturers as well, that are really just going to be continuing to make the tools to make all of this happen. You don't have to bet on somebody having the next big product. You can just play the innovation by playing who's selling the picks and shovels to make all of this happen.
Yeah, I mean, it's going to be interesting, right? As more of these companies become public and available, and finding those individual opportunities. But obviously, as an expert in the space, guys, feel free to follow ClearBridge. They have been certainly a top growth manager for a number of years. And they're definitely a wealth of knowledge. So Matt, thank you so much today for joining us, and just giving a rundown of how we got here, and where you guys see the opportunity. So thank you, and hope everyone has a wonderful rest of their day.
All right, thanks. Take care.